Hello dear students, welcome to my YouTube channel Alimuthuja for Commerce Classes. In this video we are going to learn and understand all the accounting concepts and conventions. So before going to concepts and conventions discussion, let me tell you one thing, that most of the students lack in understanding concepts and conventions in accounting. So if there is any deficiency in understanding concepts and conventions, then believe me, your understanding of accounts is incomplete. So therefore, understanding accounting concepts and conventions completely and clearly is very important for solving accounting problems. So concepts are entity concept, money measurement concept, periodicity concept, accrual concept, matching concept, going concern concept, cost concept, realization concept, dual aspect concept. Conventions are conservatism, consistency, materiality. Now let us discuss all the accounting concepts and conventions one by one. The first concept, business entity concept, also called separate entity concept. This concept says that business enterprise is a separate identity apart from its owner, which means accountants should treat a business as distinct from its owner. That means owner is separate from business. Business transactions are recorded in the books of accounts and owner's transactions in his personal books of accounts, which means owner's personal transactions should not be mixed with business transactions. This concept helps in keeping business affairs free from the influence of the personal affairs of the owner. Whatever his personal affairs are there, that means whatever he spent for household purposes, that should not be recorded in business books of accounts. So this basic concept is applied to all the organizations, whether sole proprietorship or partnership or corporate entities. Let us understand business entity concept with one example. Mr. X started business investing rupees 7 lakh, with which he purchased machinery for rupees 5 lakh and maintained the balance in hand. The financial position of the business, which is shown by balance sheet, will be as follows. Look at here, he invested 7 lakh rupees. It is nothing but capital, and bought machinery, asset side, 5 lakh rupees, cash, that is the remaining balance 2 lakh, 7 lakh, 7 lakh. This means that the enterprise owns to Mr. X rupees 7 lakh. Understand the point? Because of entity concept, that means entity concept says owner is separate and business is separate. Whenever owner, here Mr. X, invested 7 lakh rupees, it is as good as he is giving loan to business, that is 7 lakh, but we do not call it loan, but we use the term capital. Therefore the capital comes under liability side. You understood? So therefore the enterprise owns to Mr. X 7 lakh. That's the reason the 7 lakh, that is capital, comes under liability side. Now if Mr. X spends rupees 5,000 to meet his family expenses from the business fund or business cash, that should not be taken as business expenses and it would be charged to his capital account. That is, his investment, which is nothing but capital, would be reduced by rupees 5,000. Following the entity concept, the revised financial position would be like this. See, after application of entity concept, what happens? He spends 5,000 rupees to meet his family expenses from the business cash or fund. Family expenses, it can be he bought jewelry for wife, or paid children's school fees, or bought any birthday gifts, anything that is personal in nature. Then it can be 5,000, 10,000, 20,000, whatever the amount that will be deducted from capital. That is called drawings. That means we can say, because of entity concept, the new term emerged, that is called drawings. Whatever the personal expenses he spent from the business fund or business cash, that will be called drawings, and that will be reduced from capital. Now his capital or investment is 6,95,000, machinery as it is 5 lakh, and cash, it was earlier 2 lakh. Since he took for meeting family expenses, now his cash became 1,95,000, that is 2 lakh minus 5,000. Now coming to conclusion, sole proprietor is separate from sole proprietorship therefore capital comes under liability. Here one capital, since sole proprietor, that is one proprietor, single proprietor, therefore capital comes under liability. Then partners are separate from partnership firm, therefore capital comes under liability side. More than one capital, A's capital, B's capital. If there are 3 partners, then C's capital, 4 partners, then D's capital, like that. Then shareholders or investors are separate from company or corporate entities, therefore share capital comes under liability. So basically whenever these businesses, forms of businesses, sole proprietor, partnership or company, when they wind up, then ultimately the owners, they will get their investment back, whether it is a more or less, depends, because they have to clear all other debts. That is the reason they may get more than what they have invested, or they may get less than what they have invested. This is regarding business entity concept.